Well, hello everyone, and welcome to your Daily 5 for March 5, 2021. I'm Joe Duarte, author of the best-selling book, Trading Options for Dummies. After this video, please feel free to visit my website, joeduarteandthemoneyoptions.com, for a free trial subscription. And thank you for spending the next 10 minutes of your valuable time with me. Today, we're at the edge of chaos as always, and we're going to talk about managing your stock portfolio in the face of rising bond yields. Let's get started. As always, we want to always adhere to our sound trading principles. Don't fight the Fed, whatever that means these days. Don't fight the market's momentum and the dominant on the ground trends. You want to stick with the strong sectors and stocks, trading those small lots, and you focus on your stocks relative to the stock market. What that means is if you're used to buying 200-300 share lots, you might want to reduce that so the volatility doesn't affect your portfolio as much. And if your stocks are doing well, there is no reason to sell them. You also want to take profits when you get those 20% gainers. Keep the sell stops no more than 5 to 8%. You want to monitor those lagging sectors for potential turnaround candidates. And I have a stock today that I will be discussing, which meets that criteria specifically. And you want to manage your cash wisely. If you sell and your cash starts building up, don't be in a hurry to put it back in the market. Take your time and pick good stocks. So 2021, we're already on the third month. We have some emerging trends. The big one is the rising bond yields at the same time that the Fed keeps easing. And like Mr. Powell said yesterday, it's pedal to the metal. We're going to do what we're going to do. We don't care about the bond market. Bond market has inflation fears, and we've seen that a lot lately. We have a changing market leadership. Momentum stocks are getting clobbered. Other areas are starting to come up. Increased market volatility. The market doesn't like higher interest rates at this point from the bond market. Economic uncertainty. Is the economy going to rebound? Is it not? If it does rebound, how's it going to rebound? And of course, that big elephant in the room, COVID, it's evolving. We have vaccines, we have mutations, and we have the end of lockdowns in some states. How's it all going to end up? Well, let's start with the stock market. We always look at the New York Stock Exchange advanced decline line. And remember, we look at things in terms of complexity and chaos. Complexity zone above the 200-day and above the 50-day moving average, things are going well. The market is still in an uptrend. We're in the complexity zone, the edge of chaos, the 50-day moving average, 200-day moving average. That's where you have that melting pot where things, momentum builds up and the market breaks up to the upside, breaks out to the upside or breaks down. Chaos zone, things are completely out of control. You don't want to be in the chaos zone. Look at some reference points. When the market drops below its, when the New York Stock Exchange advanced decline line drops below its 50-day moving average, at the same time that the RSI drops below 50, you could have a sell signal. Right now, we are testing that 50-day moving average. A couple of more bad days, we're going to be there. RSI is already below 50. So this market is in a little bit of a transition zone, and we might actually get some heavy selling in the next couple of days if things don't hold up at these key support levels. Well, let's get right to the interest rates. We can see the US 10-year bond note yield at the top here of this ACP chart. I love ACP. It helps me see things up close and personal on an intraday basis. This, of course, is a few days worth. This is March the 2nd, and this, of course, is this morning or yesterday afternoon, excuse me. So we have a general tendency here now that as bond yields rise, stock prices of the S&P 500 have been going down. This was a point yesterday where Chairman Powell said that he didn't really want to do anything different. You can see that bond yields rose dramatically and stock prices fell dramatically. Toward the end of the day, there was a little bit of a bounce, but the general trend is at this moment, rising bond yields are not good for stocks. That's not the way it was for the last 2 or 3, 6, 8 months. You can see that the US 10-year note bond yields rose and stock prices, this is the S&P 500, this is the NASDAQ 100, kept up very nicely. It seems as money was coming out of the bond market and getting into the stock market. But of late, what we've seen is that as the US 10-year note got about 1.4%, stocks stopped liking it and they have dropped. So let's look at this in a little bit more detail. So the 30-year bond is more of an inflation expectations barometer versus the 10-year note, which is a benchmark for mortgage rates and other important lending rates. You can see that the 10-year note has and the 30-year note has pretty much been in tandem, but something may be happening here, and we need to keep an eye on it, as this morning the 10-year note kept rising its yield, and the 30-year bond now not rising as much. So maybe there's a bit of a change here. We can also see down here that the RSI for the 30-year bond, as it was for the 10-year note, is pretty overbought. So I'm thinking we're going to end with a consolidation period here in bonds for a while, and the Fed is betting on that. So what does the 10-year note yield mean for key stocks such as home builders, D.R. Horton, the upper one here, and I'm sorry, the lower one here, and Lennar, the upper one here? You can see that as bond yields have been rising, the rate of ascent in the home builders began to slow down. Now, they didn't mind it down here so much. You see that the home builders did great during this period of time, but as bond yields started creeping up above 1%, Lennar and DHI both started to have trouble. Now we're over here, and these stocks could break down. We need to keep an eye on them. However, always remember that supply and demand scenario for home builders is very positive, very low supply and very high demand. So we'll have to see how that plays out. So what about other sectors of the market? Okay, let's look at the lumber stocks. Again, we see the general trend of the US 10-year note rising. We see that this has a much higher correlation than the home builders, because by and large, as bond yields have risen, so have lumber stocks. So that means that the market, the stock market, is validating the bond market's concerns about inflation, supply chain problems in lumber, and price inflation. Lumber stocks have actually done well. Now, what's not working? Well, the poster child for momentum over the last several years has been Tesla. No matter what the bond market's been doing, Tesla's been going up. Until recently, when we got above that 1.4%, Tesla rolled over. So you want to be avoiding the momentum stocks at the moment and begin concentrating on stocks that are working, such as commodity stocks. Now, let's look at something that is extraordinary here, and is what I was talking about. Look at your individual stocks, and always look at out of favor stocks, out of favor sectors for your next set of winners. Here's Oracle, an old technology stock. IT, they did IT before it was called IT, and they're a money-making machine, but the stock is just not always a very attractive stock. It's just not as sexy as Tesla. But guess what? Oracle just broke out today. Let's look at Oracle as a good example of a stock that is worth considering. Now, first thing we want to do is look at the general price trend, and of course, Oracle is above its 50-day moving average and above its 200-day moving average. So it's at the complexity zone. That's a positive. Now, you see the accumulation distribution is not a particularly appealing looking indicator at this point, but unbalanced volume is actually good. Unbalanced volume, in this case, gets the nod over accumulation distribution. Okay, you can see that momentum is starting to pick up here. So my expectation is that if this breakout continues to be successful, then we're going to see a pickup in accumulation distribution. Even more important, ROC, which measures momentum, is starting to pick up. So now you have two positive indicators against one negative indicator. Stock is not quite overbought yet, so it's got some room to run. So Oracle is a perfect example of a stock that we're going to look at as an outlier, but that is working at the moment. Finally, volume by price. This is big bar here is support, very little resistance. So this stock, rising volume, has the potential to move significantly higher. So let's recap. We have rising bond yields, which indicate inflationary expectations. Of course, we may hit a consolidation period, and that may be a positive for the stock market. We have supply chain issues, which have made stocks like Louisiana Pacific and other lumber stocks and commodity stocks become very attractive. Economic uncertainty. Is the economy too strong? Is the Fed going to have to raise interest rates before time? Chairman Powell says no. Are we slowing in housing? Hard to know. The housing stocks are not as attractive as they were perhaps a few months ago. Money continues to move back and forth between bonds and stocks. So we're in that kind of a transition period. Rising volatility, absolutely. Caution is warranted. Sector rotation in stocks, favorable sectors, commodities, unfavorable sectors, trendy tech stocks. The bottom line, focus on individual stocks such as Oracle. That's all I have for now. I'm Joe Duarte from Joe Duarte and themoneyoptions.com. Of course, please feel free to visit my website and get a free trial. I do own shares in Oracle, Louisiana Pacific, and DR Horton at this moment. Please also read my articles on StockCharts.com, and we'll talk again.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.